Go through where?
Well, I mean, the successful way for the cable package to evolve.
No, I don't think that. I think that the cable operators are essentially now in the data transmission business and no longer really in the program business. They used to be in the program business. It's very healthy margins. Those have decreased as programmers have asked more and more money. Now, when you have so many different alternatives, they're in the data business. That's their competitive edge.
Does that explain some of the rationale behind the AT&T Time Warner deal? There has been a certain amount of skepticism, aside from the Trump element, of course, but from an operational perspective, skepticism behind it. I don't know if you think there is a logic behind that deal.
Well, I just don't think there's a lot of industrial logic behind it, but because I don't think that a data company needs to own a content company or a tech company, data company. AT&T needs to own content. It can buy the content at fair market prices. No content, I think, in this area is going to be particularly exclusive. So, but I'm not there. It's not my strategy. It's their strategy. They're smarter than me.
Well, I don't possibly cast those aspersions. You've, of course, flown in from LA to here. We're here at CES. Is there anything you're particularly looking forward to seeing? Maybe some networking you're looking forward to doing?
I don't know. That's a horrible word.
Oh, really? Okay, I'm sorry. I apologize. We're talking about networks. It was a neat segue.
Yes, yeah, I know. Well, nice segue, but not for me.
Okay.
Yeah, I'm going to wander around. I'm going to go to a few different places to see some things. I'm particularly amazed. If you came to CES 3 years ago, much less 5, 10, 15 years ago, you'd never see a car on the floor. Now, cars are technology. I mean,
do you have a vision for pushing content into cars? Putting videos into cars? Yeah, I mean, I was there at the Corning stand a little bit earlier, and they're really bullish on putting screens into cars, the back seats, into the front seat for the passengers, and they showed me this panel, essentially similar to an iPad, where they could pick out videos and push that onto the screen. Is that something that you would be keen to get into? No. Okay, simple answer. Well, thank you so much for your time. It's been insightful as ever, and I do hope you have a wonderful show.
Thanks so much.
All right, that was IAC founder and chairman Barry Diller speaking with Bloomberg's Alex Webb. They're at the Consumer Electronics Show in Las Vegas. I want to bring in now my co-anchor, What You Missed, Joe Weisenthal. And Joe, of course, they started off the conversation, Alex did, by asking Barry for his thoughts on Donald Trump's he didn't comment on it publicly, but his view that the Time Warner AT&T merger should not go forward. Barry Diller, no fan of Donald Trump.
Right, but he just hand-waved away Donald Trump's comments on all this stuff, and he basically made the point that CEOs can't be worried about 1 or 2 day stock moves because of a tweet or because of something he said in private. It doesn't change the fact that this is the new reality for a lot of companies and CEOs, that they have to consider Trump tweet risk, so to speak, and how it's going to affect their companies.
No, well said. And of course, the whole media structure and the tech world seems to be operating in a different environment now that Donald Trump is president. Under the Obama era, they were seen as the industry that was in favor.
Right.
And now they're very much seen on their back heels because they obviously did not favor Donald Trump as presidential candidate.
Yeah, no, that's absolutely true. I mean, you think of like the one industry that really grew up and grew to prominence during the Obama era, and you'd have to say sort of infotech, media tech, internet, Facebook, Google, Amazon, Netflix. And these companies had been around prior to Obama, but this is the years they really became the true establishment.
And of course, he did share his thoughts as well on M&A within the media and the tech space, specifically saying that Apple and Amazon don't need to own their content to distribute. They can do that other ways. AT&T, for instance, he says, can just buy the content, which in many ways you could argue it's trying to do with Time Warner.
Right, everyone's trying to figure out who needs to own and who can just be a platform.
Everyone's looking at Comcast and how it owns the content and the pipes and how that worked out pretty well.
Good point. All right, let's look at where the major averages stand as we head towards the close. Bloomberg's Abigail Doolittle is standing by.
Thanks so much, Joe. Well, we are looking at the first day of mixed trading action in the very young year of 2017. We have the Dow and the S&P 500 down ever so slightly, coming under pressure of the financial sector falling. But we do have the NASDAQ trading slightly higher on strength and technology. We'll be getting to a couple of those names in just a moment. But all of this ahead of the jobs report out tomorrow, 8:30 Eastern time in the morning. some jitters ahead of that report. And interestingly, when we take a look at some of the other asset classes, we are seeing a confirmation of a developing risk-on feel. Specifically, we have the Bloomberg Dollar Index down, in fact, for its second day in a row, the worst two-day drop since June. We also have the 10-year yield trading higher. This is represented in green, trading lower by 7 basis points, represented in green. This tells us that safe haven bonds are rallying. It is having its biggest drop in yield in about 4 months. So real safe haven feel there, confirmed by the yen rallying. The dollar is falling against the yen. And then finally, looking at Bitcoin. Bitcoin yesterday hit a record high, down sharply against a declining dollar. So lots of volatility here. And in fact, when we go into the Bloomberg, this risk-off feel is confirmed by gold. This is G hashtag BTV 5001. And in yellow, we have gold. In white, we have the 10-year yield. And we can see that they really traded inverse for some period of time as rates were rising, gold was dropping. But now that rates are starting to pull back a little bit, gold is starting to rally. So perhaps this will be a dynamic we'll be watching as the year goes on. It is not all risk off, though. As I mentioned, the Nasdaq is trading slightly higher, being helped by some of the big tech names, especially the internet names, the FANG names. Facebook, Amazon, Netflix, and Alphabet are all trading higher on the day. In fact, Amazon is on pace for its best day since November 15th, really being helped out by a solid 2016. They shipped 2 billion units. And most of those units, 50% of those units at least, were shipped during the holiday season, in sharp contrast to the weakness at Kohl's and Macy's.
Yeah, that is quite the contrast there. Abigail Doolittle, thank you so much. Coming up, more interviews from the Consumer Electronics Show in Vegas. We'll hear from AOL's CEO Tim Armstrong on how the Yahoo breaches are affecting its deal with Verizon. From New York, this is Bloomberg.
What do you miss? The Consumer Electronics Show is in full swing in Las Vegas, Nevada, and earlier today, we caught up with AOL CEO Tim Armstrong. We asked Tim about the status of the Yahoo hack investigations.
You know, the Yahoo deal for us is strategic towards our 2020 goals. We're hopeful it will close. The process for us is split into two areas. One is the integration and strategy planning with Marissa and the executive team at Yahoo, which has gone very well, and we have very close relationships with them. The second piece is the information that's come out about the breaches and what the effect of that is. Verizon's handling the breach research with Yahoo. Yahoo's going through their investigation, so we won't have any comments on that because Yahoo hasn't finished that investigation yet. But on the strategy and execution side of things, we're on track and hopeful that the deal will close overall. But we'll know more in the first half of this year, and I think that the Yahoo team is doing a thorough investigation, so I'm sure they'll have more to say about it in the time period in front of us.
Yeah, is it theoretically possible that these series of hacks and the public's knowledge of them has any effect on the brand and damages the brand of Yahoo in any way?
I think that's one of the things that Yahoo's looking at and will continue to look at is, the total effect of what the breach was and what the outputs of them are. And, of course, we have a viewpoint on that as well. But I think from a standpoint of where we sit right now heading into 2017, our strategy is clear heading towards 2020. Yahoo is one piece of that strategy overall. So as we get information about the breach, we'll update people on that, and Yahoo will as well. But, I'd say that from what our goals are and what we've been tasked with of getting done with Yahoo, it remains on track, and the breach is a piece of research and information and investigation that's still ongoing.
I think that the size of the business of Yahoo is not properly understood generally. I mean, I think it's because it's just such a very big business and so many users. When you look at that asset, what do you see that holds such value? Because the noise of the headlines and the concern over the breach, I think, tends to dominate the discussion. What do you see as the underlying asset and its value?
Yeah, Corey, we live in a world today which there's hundreds of billions of dollars and there's billions of consumers coming online that are all digital first and mobile first. Yahoo is one of the largest footprints in the world on the consumer side and has a very sizable advertising business and an e-commerce business in Asia. So from our standpoint, when we look at this asset, the combined asset would have over 1 billion consumers, do billions and billions of dollars in ad revenue and have a very big footprint in mobile, added with Verizon, which is very strategic. The Verizon opportunity with data and targeting and getting to mobile consumers is huge. So, I think there is the breach information and the breach investigation, but from a business strategy standpoint, especially when you look towards the next 5 to 10 years, the assets coming together represent a very unique opportunity, a very unique scale. And look, we've gone from company consolidations to industry consolidations, and Verizon has been very forward-thinking, very clear on the execution of where they think the world's going in media and in wireless and mobile, and we're excited about it. We're excited about Yahoo, excited about the team overall, and there's this one issue that needs to get resolved, but I'd look through that from my side on the integration side to look at the strategy, and I think the strategy remains intact.
That was AOL CEO Tim Armstrong.
It is time now for the Bloomberg Business Flash. Look at some of the biggest business stories in the news right now. A federal judge has confirmed penalties against 4 of the world's biggest banks for their roles in the manipulation of currency markets. Royal Bank of Scotland, JP Morgan, Citigroup, and Barclays have been fined $2.5 billion in this agreement hammered out in May of 2015. Headwinds ahead for Boeing and Airbus. The jetliner shopping spree that lasted a decade is now waning. Both companies face dwindling sales and the highest level of airplane delivery deferrals in 15 years. Sales numbers to be unveiled in a couple of days will likely show that aircraft orders are trailing shipments. That's a clear sign of a weakening market. Airlines also have less incentive to retire older planes or order new models because of the low cost of jet fuel. Amazon's Alexa will begin riding shotgun with Ford owners this summer. The automaker says it'll begin offering the voice-activated digital assistant in its cars as Amazon continues to form alliances with car makers. The first Alexa applications began rolling out in Ford electric cars and hybrids this month. Alarm bells coming from SoundCloud today, the online music company warning it risks running out of money if its subscription service doesn't gain traction. An industry analyst estimates that subscribers at 250,000 compared to Spotify's 40 million or 20 million for Apple. SoundCloud says it may have to raise additional funding to meet financial obligations. It has already explored a sale of the company. And that is your Business Flash update. All right, we want to stay with company news and take a deep dive now. And a reminder that you can find our charts using the function at the bottom of the screen. And I'm taking a look at Macy's because, of course, following on the heels of yesterday's big news, Joe, that it's cutting 6,200 jobs. Its holiday sales numbers were kind of disappointing, prompting it to reduce its full-year forecast. I wanted to take a look at how Macy's stacks up versus its peers. And this is using the RV function on the Bloomberg. And what you'll see here is that the same-store sales number for the third quarter, again, Macy's only pre-announcing for the fourth quarter. For the third quarter that had been reported was a drop of 3.3%. Sounds bad, but it actually is ahead of the median. It's actually doing better than its peers. Its peers have a low of 7.4% decline or a gain of 2.4%. And following on that as well, EBITDA margin over at Macy's is much better than its peers, 12.5%, near the high of the range, which is the highest point was 12.95% among its peers. The median is somewhere in the neighborhood of about positive 6% or so. So that I found fascinating. And again, you can, if you wanted to, look at more details here. You can stack things or rank things by revenue growth over the past year. And you can see that over the past year, Macy's has seen revenue drop 3.5%. Kohl's, meantime, which also pre-announced disappointing results.
Data yesterday.
Yeah,
you look at that.
Growth
you look at
9%.
that peer group: Kohl's, Nordstrom, Penny, Diller, Sears. Not exactly the companies you associate with doing all that well these days. So. As bad as Macy's doing relative to its peers, it's actually not so bad.
Not so bad. Sears doing much worse. And, of course, we had disappointing news out of Sears as well today.
Very cool. I'm looking at some data we got out this morning. Initial jobless claims coming in quite low. And I have a favorite way of looking at this data, which I bring up on the show every couple months or so. It's unadjusted claims with the 52-week moving average. So you see it's very spiky when you use the unadjusted number because that accounts for regional or sort of seasonal variations, people getting laid off after the holidays. But the orange dotted line is the smoothed out number for the entire year. And we just hit yet another all-time low, or post-crisis low on this measure. If we just zoom in over the last year, you can see it's just this steady drip lower. So this is sort of one measure of the labor market. There are all different ways of measuring the labor market. Of course, we're going to have the jobs data tomorrow, but this just keeps grinding lower. Pretty impressive.
It's a reminder that you shouldn't pay attention to the weekly numbers.
Exactly. Very noisy data always. There are all kinds of factors. Weather could be a factor. A strike somewhere in a random state could be a factor. So it's a nice way of smoothing it out.
And I'm glad you brought up the jobs report. If you come inside the Bloomberg, I wanted to bring up WIS Go. This is WHIS Go. And this is where Bloomberg users can enter their own estimate for what they think the non-farm payrolls number will be. Right now, the consensus estimate among economists that we surveyed is for a gain of 175,000. In the previous month, in November, we had 178,000. The whisper number right now, Joe, is a gain of 180,000.
So folks
close.
are feeling kind of bullish.
Folks are feeling kind of bullish. We'll see. What'd you miss? The UK could be heading for a hard Brexit. That's according to Moritz Kramer. He is Chief Ratings Officer for S&P. Earlier today, he spoke to Bloomberg Markets Middle East and warned that the parties at the negotiating table are still very far apart.
In my mind, the likelihood of a hard Brexit has been increasing over the last couple of months. Hard Brexit meaning that basically the UK would leave the EU without sort of any substitute agreement in place. I think the reason for that is really twofold. The first one is simple. It's just the lack of time. I mean, this is an awfully short period of time to negotiate such a complex web of relationships. And the second one is really that the two starting positions of the negotiations seem to be so far apart that I'm struggling to see any overlap where compromises could be struck. The UK seems to be saying, that's what I hear, is sort of we want to control immigration, full stop. We want to be sort of not under the jurisdiction of the European Court of Justice, full stop. The European side, on the other side, seems to be suggesting that, look, the EU is basically not a buffet where you can pick and choose what you want. It's a set menu. You've got to take it all or nothing. So if you want to control your borders on immigration, then that means that the customs union and the single market is not going to be available to you either. How you can square that circle is quite uncertain to me, and it seems to be going rather slowly in terms of the UK actually defining its strategy.
Moritz, the thing is, this is political positioning, isn't it, really, as well? People are not going to show their hands before negotiations begin. So, you know, at the end of the day, we've got to wait till that Article 50 is actually presented.
Well, maybe. You see, I think they are showing their hand. I mean, they're saying we want full immigration control. I think it is not a secret that this is going to be very, very difficult to reconcile with access and free trade to the EU. But I think what many people actually overlook, it's not so much the trade in goods and cars and stuff. I mean, the thing that really matters to the UK much more than industry is services, because the UK is a major service exporter. And even sort of if you get some free trade on goods and services, this would benefit countries like Germany or Italy or France, which are exporting mostly goods to the UK. But the UK is much more dependent on selling services, financial services, business services. That's their strength. That's the comparative advantage of the UK. And that's much more difficult. There's no WTO. There's no preset arrangement that you could adopt. So I think that the time is really very, very short. And we haven't really seen any clear formulation of the road the UK wants to travel.
That was S&P Ratings Chief Moritz Kramer speaking earlier on Bloomberg Markets Middle East. Still ahead on Options Insight, today's trade is on the iShares Mexico ETF, the EWW. We'll get a strategist's take on what to do with this ETF. This is Bloomberg. Time now for Options Insight with Julie Hyman.
Yes, Scarlet, we have a special Would You Miss edition today. And joining me for today's Options Insight is Jim Struger of MKM Holdings. Jim, we're seeing some sort of chinks in the rally today and really over the past several days. One of the things we've been looking at, and I know you've been watching regularly, is the skew on the SPY as well as on the S&P 500, the implied volatility. We have a chart of that on the Bloomberg, and it's kind of creeping back up to more normal levels after being suppressed during the election. I think we have a chart of that we can look at on the Bloomberg. Anyone? So anyway, if you can talk to that about sort of how people are maybe doubting the rally to some extent or hedging it.
Sure. So what this graph represents is the relationship between call implied volatility and put implied volatility. The way skew has flattened, as it has in this graph, is mostly over the last several weeks due to call implied volatility getting bid up. So what happened is people came into the election, they were more or less on their heels, and over the last month and a half, essentially, they have chased up call implied volatility to get longer stocks. So with that, call implied volatility has lifted. Put implied volatility hasn't moved a whole lot. That is what has flattened out this graph. That said, to your point, what we've seen over the last week is people looking at the other side of some of the trades that have been put on since the election. So obviously, the market has acted phenomenally well. Energy, financials have been fantastic. And then if you look at other asset classes, U.S. Treasury yields higher, dollar stronger, gold lower. So many of the trades we're seeing today and over the last few days are taking the other side of a lot of these positions. Something we talked about last week on here was using that skew to your advantage. One of the ways you can do that is via hedges. If you're long a stock and the skew is apparent at the single stock level, not just at the index level, you're long a single stock, let's say you want some protection around the inauguration or just over the next month or so, the beginning of 2017, you can, against that long stock, sell an upside call, turn around and buy a downside put. That creates a collar and at the same time exploits this skew relationship that we're talking about.
And now, as you say, we've had a lot of trends since the election that now seem to be wobbling a little bit, whether it's people hedging, taking profits, what have you, or more fundamental doubts. One of those trades that's been in place is Mexico, right? We saw it again today when Donald Trump tweeted about Toyota building a plant south of the border, that he would impose a border tax. We saw the reaction of the peso. You're looking at the EWW, which is an ETF that tracks Mexico. So what are your thoughts here on the trade that we've seen and what could happen next?
Well, this is a product that's worth putting on your screen and watching on a Bloomberg for the next several months, if not a couple of years, because it's going to be in play. If you go back to the election, right around that period, there were 700,000 open interest in EWW, an all-time record. That's come down pretty sharply, but for the reasons you just talked about, 3-4 tweets from the president-elect over the last several days, specifically related to automakers in Mexico. This is a product that's going to be in play for quite a while. What we want to look at doing here is actually playing directionally long in EWW. So it's the iShares Mexican ETF. And the reason is that it's down about 18% since the election. It's almost all related to the peso. In local currency terms, the underlying components of EWW on a weighted basis are down about 2%. This is all about the Mexican peso.
Gotcha.
Mexican monetary authorities look to tighten this morning. They obviously want to support the peso. What we want to do is just go out to March and put on 44, 49 risk reversals. Sell a put, buy a call, get long directional.
Okay, got to leave it there. Jim Struger of MKM Holdings. The market close coming next.
market close is here. Take a look. We are looking at S&P 500 and the Dow slipping a bit, but the Nasdaq reaching a record high. This comes after a two-day advance as investors assess some mixed economic data. I'm Scarlet Fu.
And I'm Joe Weisenthal. And if you're tuning in live on Twitter, we want to welcome you to our closing bell coverage every weekday from 4 to 5 p.m. Eastern.
We begin with our market minutes. As I mentioned, the Nasdaq actually creeping up to a record high. We hadn't noticed that. It was kind of a stealthy move up.
Definitely stealthy because S&P and Dow, as you can see, in the red. Another day of no Dow 20,000, but Nasdaq moving higher.
All right, let's look at a sector breakdown here. I'm checking the IMAP on Bloomberg, and this, of course, gives you a breakdown of what the sector performance has been. Financials leading the slide down more than 1%. They, of course, were the biggest gainers after the elections, and you can see they're red across the board for that sector. What surprised me, though, was that consumer discretionary, which includes retailers, actually mixed on the day, despite the negative headlines out of Macy's and Kohl's last night. But the big moves today came courtesy of President-elect Donald Trump. A Bloomberg News headline.
That's a sentence you might be saying a lot.
I know, right? Yeah, bottle that one. Donald Trump reportedly told a confidant that he still opposes the merger of AT&T and Time Warner because it would concentrate too much power in one company. He's also said to be frustrated with Comcast and NBC Universal. You saw both those stocks take a leg down following that headline.
And let's look at government bonds because there was quite a bit of action there, particularly at the U.S. 10-year where yields fell to 2.36%. Pretty dramatic, also pretty big decline there at the 2-year level. So we're seeing some pretty big reversals of some of these post-election trends. A rally today in Treasuries is clearly one of them. Also on a spotlight, Portuguese 10-year yields above 4%. Pretty big move. Some of those peripheral European yields starting to rise again, so keep your eyes on Europe. And I want to look at a one-month chart of the U.S. 10-year yield, which really shows dramatically how much yields have come in. We're still a lot higher than we were pre-election, but notice something, which is that we're now below where we were on December 14th, the day of the Fed meeting. Of course, we got that hike and the raised dots on that December 14th meeting. Long-term yields now below the levels of that day. So quite a turnaround. It maybe hasn't got as much attention as it ought to have. Something to keep your eye on.
It's been pretty swift, to say the least. All right, let's look at the dollar index here. It's at, if you look at one-month chart, clearly it's moved to a new low in terms of the lowest in more than 3 weeks. So along with that idea that yields have come down, we also have the dollar losing some steam. You had interventions by central banks in Mexico and China. The weakness in the dollar was broad-based. If you look at the dollar versus the G10 peers, lower across the board. Vince Signorella of Bloomberg First Word reminds us that liquidity is still pretty thin here. The start of the year is just as bad in terms of liquidity as the end of the year because corporates are really not in the market. If you look at the Mexican peso on an intraday basis, the central bank, as I mentioned, defending the currency, selling dollars directly to banks in New York. That accounts for that big leg lower in the dollar versus the Mexican peso. But then since then, you could see that the dollar has made its way higher once again. The action did help the peso rebound a bit temporarily from a record low.
So traders testing the Bank of Mexico, not letting that move happen.
Exactly.
Go very far.
And a two-day glimpse of the Chinese yuan, the offshore yuan, posting a record two-day rally. The consensus here, Joe, was that China would continue to let its currency weaken gradually in contrast to sudden devaluations like we saw in August of 2015 and January of last year. But that consensus trade seems to be blowing up a little bit in the new year here.
Lots of interventions. Let's take a quick look at commodities where we see a rally in platinum and gold, both of those precious metals doing well. Platinum has been doing well for a while. Gold futures up 1.4%. Gold really got hammered after the election, but it's on a kind of a winning streak now, trying to get back to 1,200. And NYMEX crude hanging in there with a modest 0.8% gain.
I'm pretty sure that gold tends to rally at the start of the year. That's what happened last year as well. We'll have to use that for a deep dive.
Yeah, we'll look at the seasonals.
All right, those are today's market minutes. We want to take a deep dive now into the Bloomberg. You can find the charts using the function at the bottom of the screen. And I want to stay with the idea of reflation and inflation because what we're seeing is that in Switzerland, on a year-over-year basis, consumer prices have stopped falling. Headline CPI is no longer negative. Come inside the Bloomberg here, and you'll see that CPI has ended the worst slump in at least 40 years. Inflation coming in at 0 in December, but that follows a read of 0.3%, a negative 0.3%.
Raging inflation, consumer prices at 0.
Well, okay, I don't know if Switzerland's out of the woods yet. You had 2 previous bouts of deflation, 6 months of declines here, 20 months of declines there. That, obviously that ended, but not for long. So the question is still out there.
Well, let's talk about it some more. What do you miss? Switzerland joining other parts of the euro area, seeing producer price inflation rise, expectations of U.S. growth, faster ongoing monetary policy, help pulling the world back from the deflationary brink. Dan Moss, Bloomberg executive editor for global economics, and Andrew Wong, Bloomberg FX reporter, joins us now. Dan, we've talked about this. It's the existential question that will define 2017. Is this the real deal? Have we shifted regime change from deflation to inflation?
I'll take the middle path, Joe. And
no, this is TV.
Yeah, and here's why. Scarlet, your graphic on the Swiss franc was very telling. It's showing the abatement or possibly the end of deflationary forces. It's not showing a surge in inflation.
Let's go back to the
We don't appear to be going back to a situation where inflation is, quote, a problem. Some of the sizes and scopes on these monthly moves have obscured the fact that the central banks are still below target, but they are no longer negative.
Yeah, I mean, the last time Switzerland saw inflation, real inflation, was back in 1990 when it reached, oh my goodness, 7%, 6.6%.
Unimaginable. Andrea, this is obviously a key debate for currency traders because they're so sensitive to rates and central banks. How are the currency markets so far this year reading these sort of inflationary forces that we may be seeing, or at least the end of the disinflation?
Yeah, that's a very interesting question because for the longest time, the U.S. is one of the few developed nations that are actually seeing any inflation, and it's the only and the Fed's really the only central bank that's looking at its inflation data. Yeah, it's really moving towards our target. So now you have signs of inflation in other places, in Europe, in Euro area, in some parts of Asia. Now the question becomes, is it a divergence trade or is it a convergence trade? And the dollar hasn't been doing so well in the past few days, and some people argue that maybe the rest of the world is converging with the US on the inflation front.
Well, if you take the German CPI that was published the other day, again, the result was significantly above expectations, but still below where we were in 2011. So, this could really just be the end of a period of abnormality and a return to the trend, which is still historically low, just not negative.
I'm glad you bring up the German inflation because that was attributed to an increase in the pricing of holiday packages. So some people say that it was temporary, it's not going to last. Does it matter, though, what the catalyst is for pickup inflation? I mean, does inflation beget inflation? If we see inflation pick up in December, will that prompt more inflation, no matter if it's a temporary catalyst or not?
Right, well, so that was the catalyst for that particular German data set. There may be enough different things going on in different parts of the world for different reasons that add up to an overall trend, so that the thing about the holiday pricing is not necessarily that important. It hasn't attracted much attention, but Andrea's probably noticed it. We have ended now, by a couple of months, 4 years of PPI declines in China. Now, if you buy the idea that China was a source of disinflationary trend over the past couple of decades, then the end of negative PPI could turn out to be quite a thing.
Andrea, one of the most consensus views going into 2017, long the dollar, divergence, inflation, rate hikes, so far not really working out, huh? I mean, we're just a few days in. We've had already a pretty dramatic move.
Yeah, you're right. If you look at the move, the decline in the dollar today and yesterday, we basically wiped out all the 2017 moves we've had so far, although it's only 5 days. But yeah, like people, when you have data, it leads to, a lot of the soul searching. When you have bad data, people go, all the soul searching going on about all the Trump rally that we've been driving. Is it real? How real is it? And then I think today, yesterday, and tomorrow, when we have the non-farm payroll data, is when people really sit back and think, where the U.S. economy is going.
How much of this is just, a very crowded trade that had to unwind? I mean, who wasn't long the dollar going into this year?
Well, I mean, if you compare how crowded it is right now compared to, for example, early 2015, late 2014, when the dollar again had like a mega rally, I think the position is probably a little lighter than back then. But still, if you ask a real money hedge funds, they're all in the long dollar trade.
You mentioned how the U.S. is seeing inflation, or it was the lone place where you could see any sign of inflation. If you come inside the Bloomberg here, this kind of highlights where we're seeing that inflation. Core CPI, the blue line here, above 2%. CPI and PC both moving higher as well. Dan, once upon a time, there was inflation above that 2% mandate, and it was back in 2012, and that was when oil prices were trading around about $100. How much of it is inflation tied ultimately to how oil prices move, even core?
Well, look, it's part of the mix, but just, Scarlet, to come back to this graphic, it still shows we are more or less around 2%. And while Andrea's right, the US has had inflation. It's been inflation that for the last few years has been annoyingly below the Fed's target. We've had this narrative and all these market stories like, oh, the Fed has failed and QE hasn't generated inflation. So does this mean we have to start asking, have central banks succeeded?
All right, well, maybe after years and years, a modest victory lap. Dan Moss, Bloomberg Executive Editor of Global Economics, and Andrea Wong, Bloomberg FX reporter. Thanks to both of you.
Coming up, Gap is reporting December sales any moment now. We'll be bringing those numbers to you. And, of course, it comes on the heels of some disappointing results out of Macy's and Kohl's this week. From New York, this is Bloomberg.
I'm Courtney Collins. Let's get to Bloomberg's First Word News. President-elect Donald Trump was deposed today in a lawsuit involving a celebrity chef. Trump sued Jose Andres after the chef canceled plans to open a Spanish-themed restaurant at Trump's new hotel in Washington. The move was in response to Trump's inflammatory comments about Mexicans. The last time a president or president-elect was deposed was in 1998 when Bill Clinton testified in the Paula Jones sexual harassment suit. Senate Democrats want an investigation into the finances of President-elect Donald Trump's choice to head Health and Human Services. Congressman Tom Price reportedly traded more than $300,000 in shares of health-related companies while backing legislation that could have affected the stock. A spokesman for Price said Price complied with the law. Meanwhile, House Speaker Paul Ryan says revamping the U.S. criminal justice system will be a priority in the new Congress. He spoke during his weekly news conference.
This is something that we wanted to get done last year. We ran out of time. We intend to pick up where we left off and get moving again on criminal justice reform. I think it's good policy, the right thing to do for lots of reasons. And yes, this is a priority of ours.
Ryan also discussed the intelligence gathering, saying officials who work in that field are doing, quote, an incredible job, but that clearly there's room for improvement. And national intelligence officials say they're even more convinced now than in October that Russia did interfere in the U.S. election. Senate Armed Services Committee Chairman John McCain said that at a hearing today that, quote, every American should be alarmed. The White House isn't characterizing the hacking as an act of war, but says President Obama takes the issue quite seriously. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Courtney Collins. This is Bloomberg. Scarlet?
Thank you so much, Courtney. What'd you miss? Retail stores having the worst holiday season since 2008, and the stocks, at least some of them, are taking a hit. Shares of Macy's, L Brands, and Kohl's all sinking today. You could see their Macy's down 14%. It is cutting 6,200 jobs and reducing its full-year outlook as well. And we also have Gap results same-store sale numbers as well. And December comparable sales gaining 4%. So it's not all bad news for the retailers across the board.
Yeah, the first headline we see, Gap same-store sales up 4% in December. So not a complete disaster on the retail. Stock up 6.5% off that headline. So, now up 12%.
Well, here's why, because the consensus estimate was supposed to be down 1.7%. So this was an unexpected gain. And
you can see that sharp line up. Yep. That is a gap, not the shape of a line we're used to seeing for retailers over the last 2 days, but at least some good news versus everything we've seen yesterday and earlier this week.
So joining us now is Bloomberg retail reporter Matt Townsend, as well as Bloomberg Intelligence retail analyst Poonam Goyal. So Matt, I guess what this really indicates is that apparel is not the weak part of retail that we thought it might have been.
Yeah, I mean, it looks like it's turning out that way, given what the department stores said, where apparel is somewhat okay, but accessories and handbags are the problem, the higher priced products. So yeah, for Gap, I mean, they haven't had a positive comp for a quarter since, I think, the fourth quarter of 2015.
Really?
So they were down 1 in November. So this is a good sign for Gap. Now, with all sort of reports like this, we don't know what the cost was to get these sales. I mean, they could have really destroyed their margins, and it could be a bad quarter overall. But
a few other headlines coming out. Old Navy comp sales up 12% versus an estimated 2.3% gain, so that also looks very strong. On the weaker side, Banana Republic comp sales down 7%. They had been estimated to fall 5%, so that category looks weaker. We'll be keeping an eye out for these headlines. Poonam, I want to go to you. A lot of the weakness seems specifically about the end of the mall traffic not doing what it was, not doing well, really hurting a lot of the department stores that form the anchors of a lot of malls. Are there any types of malls that are thriving? Are there still some areas that are doing well, or is pretty much that entire way of shopping going away?
Good question.
Sure. So I guess, I'd talk about there are about 600 shopping malls in the U.S. that actually are A or B shopping centers. That's what it said. And those are doing pretty well. The problem is when you have stores like Macy's with 700 plus stores, Kohl's with over 1,000 stores, they're in malls where traffic has really slumped. So the challenge has been and continues to be driving people to the stores and to the malls. And there's really no easy fix for that, at least immediately. Now, retailers like Gap, which are also mall-based, have done a little better, at least in December. And part of that is due to, as you said, apparel strength, which was driven, my guess is, by cold weather apparel, since the weather did cool. And last year we had such a warm winter that it really dragged results.
Let me just interrupt for a second here, because Gap, in addition to reporting better than expected comparable sales for December, also raising modestly its guidance for the full year. It's now seeing full year adjusted earnings per share modestly above its prior guidance. Those are the words it uses. It had seen $1.92 for full year EPS. Now it sees it modestly above that level. Matt, when Poonam mentioned that we have all these malls out there, and some of them are not doing as well, and Macy's is reducing its store count, for instance. Right. That seems to be an incremental way of addressing the problem, reducing store count. It doesn't actually get at the heart of the matter, does it?
Yeah, that's kind of what's been the writing on the wall for these companies for a while, is maybe a company needs to take a big sort of hack at their store base, and sort of get rid of this problem all at once. But the thing, like she was saying about the malls, is that malls are not dying. It's some of the malls are dying. And there's sort of this big sort of idea like malls are dead, they're going to go away. They're not. Certain malls are really troubled. And you see a big dichotomy with a company like Macy's or JCPenney, where the stores and the good malls do really well, are profitable. The ones that aren't don't. And those are the ones that they're closing.
Poonam, a headline that really caught my eye today: Amazon is launching a brick and mortar bookstore in Manhattan. I think they already have one of these in Seattle. Maybe they have another one somewhere else. They're sort of dipping their toe into physical retail. What's going on here? Are they just trolling physical retailers, provoking them?
Yeah.
Is this an experiment? Is this, what's the idea?
I'd say it's a combination of everything. The online-only retailers have really done well online, but they're realizing that it's nice to have brick-and-mortar presence. Probably not 1,000 stores, but they're testing the ground with pop-up stores, with location in densely populated cities. And I would expect in the near future that we would see more online retailers enter the brick-and-mortar space just to give a better perception on their product, and also as a distribution center for their online presence, where customers can come, pick up merchandise, they can deliver from there, and also use them as hubs for returns.
At the same time, you have the traditional retailers like Macy's investing more in its online business, as well as its off-price concept, right, with the Macy's backstage stores.
Yes.
Poonam, isn't Macy's a bit late to this game? Nordstrom's been doing it for a while, and the same-store sales at Nordstrom Rack have not been as robust as they once were.
Macy's is late to the game, but they have Bloomingdale's and they have Bloomingdale's outlets. So it's really the mid-tier business that's late to the game. Traditionally, you had seen off-price concepts only at luxury brands because that's where you wanted the discount. And to see them at the mid-tier retailers is new, and it emulates more the TJ Maxx, the Burlington stores, and Ross stores strategy rather than luxury brands on sale, which is what the higher-end department stores had traditionally.
And, of course, just more headlines there on Barnes & Noble's. The Barnes & Noble CEO was on Bloomberg Television earlier today saying that store visits declined across the U.S. retail landscape. And Matt, he was saying that he's at a loss to explain weak store visits. That seems to be a common problem with these CEOs.
Yeah, he's very, very quick to say it's not just a Barnes & Noble problem. It's, if you look at the department stores, and he said, even if I've been talking to other retail CEOs and traffic was weak across the board, but he was really at a loss to explain it. He said, I thought the election was the problem. I thought we'd bounce back. That wasn't the problem. Things didn't get better. So, is this a long-term trend, or is this just a really bad holiday? Is this a continuation of people going online, shopping online?
I mean, is there any reason to think this is not just what's been going on for a decade
I've been
now?
covering retail for 4 or 5 years, maybe longer, and the trend each holiday is the traditional brick-and-mortar stores do worse. The online stores do better. Their online businesses do better. It seems like a trend that's not going
and it
back
doesn't seem like
way.
a real mystery what's going on.
So, Poonam, if we wrap this all together, are these retailers going to end up like Sears, where they need a benefactor like Eddie Lampert to continue putting money into the business and selling assets and doing some financial engineering until the stores can get back to profitability?
No, I don't think they're at that stage right now. I think, though, they do need to rethink their business model. They need to rethink how they offer and target goods to market. But Sears has had a long way of comps being negative. The department stores have just entered that territory, and they are trying to fix it. It's just the customer has changed. The customer is not interested, is not loyal, and is really shopping from home. So that 20% of the business that's growing double digits isn't enough. They have to fix the 80% of the business, which is in store still.
All right, so a pretty big task ahead of them. Bloomberg intelligence analyst Poonam Goyal, Bloomberg's Matt Townsend, thank you so much.
Coming up, planning on investing in Bitcoin after it reached an all-time high yesterday? Well, you want to see this chart. This is Bloomberg.
I'm Scarlet Fu. What'd you miss? Let's take a deep dive into the Bloomberg. You can find all the charts using the function at the bottom of the screen. And I'm taking a look at the dollar. We talked a little bit about this with Andrew Wong and how there's still more room for the dollar to rise because the positioning indicates that it's actually investors and traders, particularly those in hedge funds, are less bullishly biased than they were at the start of previous dollar rallies. So the blue bars are net U.S. dollar long positions, and they continue to rise, which means the U.S. dollar does have room because compared to the start of 2016, which is the second green circle, and this first green circle, which is the start of 2015, the positioning is lower than those periods, and so the dollar continued to rise then. So even though the dollar index for the most part is trading near a record high, there's still potentially room. Yeah, it's surprising in a way because it seems like the long dollar position is so consensus, but I guess there's still room for it to go up. Maybe it won't go down as hard, though, obviously getting slammed today. Yeah, well, there's going to be some consolidation along the way, and that's what we've seen in the last week and a half. So speaking of getting slammed, maybe there's some sort of contrarian indicator sign. Yesterday we talked about Bitcoin and how it was surging. Well, let's take another look at it today. In the Bloomberg, getting absolutely destroyed today, down 11%. The white bars are every daily move for the last 5 years. It's very volatile, so this is not actually the biggest move, but it is very big. The red line is just Bitcoin itself. If we zoom in, we can really see what's going on. You can see the big drop in the red line and the huge 11.3% drop in the daily bars. So that's what happens. We never talk about Bitcoin on the show. Then one day we talk about it, and then it plunges. So there's your lesson. And what we need to do is overlay the Chinese yuan on top of that, because the Chinese yuan... That's also a great chart. We'll do that one tomorrow. Okay, there we go. Coming up next, 3 U.S. spy chiefs testified today that Russia's most senior leaders approved interference in the U.S. election. How will they convince, though, a skeptical President-elect Trump? From New York, this is Bloomberg. Courtney Collins. Let's get to Bloomberg's First Word News. President Obama is expected to issue at least one more batch of pardons before leaving office. The White House says they'll likely be nonviolent drug offenders. Some high-profile people who are seeking compassion: Bo Bergdahl, the Army sergeant who left his post in Afghanistan and was held for 5 years by the Taliban, and Chelsea Manning, who leaked classified government and military documents.
President-elect Donald Trump will appoint former Indiana Senator Dan Coats as Director of National Intelligence. That's according to a person briefed on the decision, who says the pick could be announced this week. Coats is a conservative who spent 16 years in the Senate. He announced his retirement last year and did not seek re-election. And Donald Trump is still opposed to the mega merger between AT&T and Time Warner because he believes it would concentrate too much power in the media industry. That's according to people close to Trump. He blasted the deal during his presidential campaign.
As an example of the power structure I'm fighting, AT&T is buying Time Warner and thus CNN, a deal we will not approve in my administration because it's too much concentration of power in the hands of too few.
Another person familiar with the matter says Trump's chief strategist, Steve Bannon, is also opposed to the deal. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Courtney Collins. This is Bloomberg. Scarlet?
Thank you so much, Courtney. For more on Donald Trump's opposition to that merger is Bloomberg's media reporter Jerry Smith, who got the scoop. Nice work. Congratulations. So what does this mean for the deal going forward? I mean, does it necessarily mean that it can't happen because Donald Trump has voiced opposition to it, albeit candidly?
Yeah, I mean, there's a lot that we don't know, like how exactly he would go about potentially blocking the deal, or whether he wants to influence the deal at all, or if he's just, expressing his opinion to people in his inner circle. But we do know that back in October during the campaign, he very emphatically said that he was going to block this deal, and what our sources are telling us is that he hasn't changed his mind since then.
So here's what I don't get, and I'm not diminishing your scoop at all. But if he said this, he said we're going to block it. He said it was not. He didn't say we're going to take a close look at this deal. He said we're going to block it. When you reported the scoop, he still believes it. The stock plunged nearly 4% after your report. It rebounded a little bit. But why didn't people listen to that before when he said this? It was 2 weeks. It was 2 weeks before the election.
Right. I mean, I think that says a lot about sort of President-elect Trump. He's very unpredictable, and the fact that he's maintaining a position that he's already stated publicly months ago, comes as a surprise, right, I guess, to some.
So the fact that he's consistent, the fact that what he said on the Trail is actually maybe some guide to his policy, is something perhaps investors haven't fully internalized yet. He might mean what he says.
Exactly.
Well, because there have been other instances where he's done the opposite after pledging to do one thing. Here's my question. Is this retribution for how the media treated him during the campaign? Because he had complained about that as well. And our Sahil Kapoor was explaining to us that the timing-wise, or I believe it was Kevin Cirilli, that timing-wise, that when he first voiced opposition to the deal, it was in response to NBC and Comcast releasing the Access Hollywood tapes, or the leak of that, I should say.
Right. I mean, what our sources tell us is that he is, he's opposed to the AT&T Time Warner deal in part because he's frustrated with CNN, which is owned by Time Warner, and he feels like their coverage has been unfair to him. He's also, one of our sources told us that he's frustrated with NBC and Comcast, which owns NBC, and he feels like they were responsible for the leak of the Access Hollywood tape a few months ago. So he sees that deal, in which it goes back a few years, where Comcast bought NBC, as an example of the concentration of power in media that he's trying to fight.
How freaked out are media executives that there may be a president who will exact retribution, in theory, if that's what's going on with this AT&T Time Warner, if it is blocked, for their reporting and potentially hurting their stock prices in business?
Well, what we do know is what AT&T CEO Randall Stephenson said back in December. He spoke at an investor conference, and he said that he was confident this deal would go through. If you look at the matter of the law, he thought this would be fairly straightforward, and he was very confident. And he did express some openness to agreeing to some conditions to the deal if that would help ease any concerns and get the deal approved.
All right, Jerry Smith, thank you very much. Fascinating, great scoop. Appreciate you coming on. What you miss? In a Senate hearing today, U.S. intelligence officials stood firm in their conclusion that Russia's most senior officials authorized hacking of the U.S. election. This hearing is one day before intelligence officials will brief President-elect Trump on the hacking. Trump has publicly questioned the findings of the intelligence community. For more on this, let's turn to Nafisa Saeed. She's our national security correspondent in Washington. Nafisa, thank you very much for joining us. So what are we learning from these hearings?
We're finding out that the intelligence community is not backing down from their findings that they initially told us a few months ago. If anything, we heard today Director of National Intelligence James Clapper said since they're initially coming out publicly, they're even more resolute. They have very high confidence in their finding that Russia is responsible for hacking into U.S. Political institutions and election last year.
And we know this is something President Obama has pointed out as well. Senator John McCain, who's a Republican, has also said that he believes this threat of Russian hacking. Talk about the implications, though, of what a Republican mainstream Congress believing one thing and the president-elect, a Republican, not believing in this possibility. It's a fractious relationship, isn't it?
Right. We heard that today in the hearing repeatedly. We heard it from John McCain. We heard it from Senator Lindsey Graham, who said, you know, even if the president, he even addressed, said, Mr. President-elect, if you're going to be skeptical, that's fine. But please know that these are people who you need to rely on and who you're going to need to get information from. So you see that friction, especially around a lot of people who in the Senate who are very strong when it comes to foreign policy. And so how that's going to play out around some of the things that Donald Trump will want to carry out in his party, in his platform, and then what the tension, if there's going to be tension. Not only that, but also the tension with intelligence agencies who he's going to have to work with.
The hack of the Podesta email is pretty unsophisticated, right? I mean, it was just a phishing scheme like anyone could have sent. It doesn't seem like is some very complicated cyber espionage that would have to be executed at the highest levels of, technical power.
Right. I mean, we hear repeatedly that spear phishing, these phishing campaigns are still one of the top ways that U.S. government systems are penetrated by cyber attackers. But at the same time, there's a lot more that goes into this in terms of how the U.S. decided and came to the conclusion that it was Russia, and that they say only the senior most Russian officials could have directed this kind of attack. And so that's what we're waiting to hear more about, and what I think Donald Trump has keeps asking for more evidence. And so that's something that, besides just saying that it was a spear phishing attack, there's a lot of other things that the intelligence officials and researchers have to go and put together, and it takes other kinds of evidence to come to that conclusion so they can think and make that kind of rock-solid conclusion.
Donald Trump tweeted about Julian Assange, saying he wasn't really on his side. He was just amplifying what he said. He attacked also the dishonest media, which of course he does. How weird is it for Republicans to now have a party leader who, if not supporting Assange, at least is eager to amplify his findings?
That also came up today in the hearing from Republicans and the intelligence officials. And, they said he's somebody that we look to who's put American lives in danger, that he's not thought of highly within the intelligence community or among Republicans. And so it does create sort of this awkward tension where with Donald Trump saying publicly, even going out to quote Assange on Twitter, really puts him in an awkward position with the Republicans, people from his own party. And he even said in one of his tweets the other day that Russia didn't give Assange the leaks, the emails that were leaked on WikiLeaks from the Democratic Party. So again, that creates some tension there because he's quoting Assange, even if he says, I don't necessarily, support him.
All right, Nafisa Saeed, Bloomberg's national security reporter, thank you very much.
Thank you.
Coming up, Vanguard CEO Bill McNabb says the market may have gotten a little bit ahead of itself. We'll hear his views on the future of passive investing. From New York, this is Bloomberg.
What'd you miss? Vanguard CEO Bill McNabb predicts the amount of money in passive funds could double in the next 10 years. Earlier on Bloomberg Daybreak Americas, McNabb commented on recent market activity and low-cost investing.
The focus on fees is something that is going to continue. If you think about what's driving it, there are really kind of two factors. One, we believe, and we have expressed this for the last couple of years, that for the next decade or so, we're going to see lower returns in equities and bonds, just looking at valuations and yields and so forth. I think that's pretty safe to say. And so if you look at, cost as a percentage of return, it becomes a lot more relevant. The second element that's going on is there's really been an embracing of the concept that asset allocation is the most important thing you can get right from a portfolio standpoint. So you're seeing advisors to retail clients, you're seeing big institutional investors and so forth focus really heavily on asset allocation, so getting the right mix of stocks, bonds, cash, and other asset classes, as opposed to trying to pick the single best fund or the single best security. And what we know is, from all the academic research, that's 90% of your portfolio return is going to be due to the asset allocation. And so again, what you see is investors expressing that asset allocation in lower cost vehicles that are simple and broadly diversified and pretty pure.
Bill, the amount of times we talk about passive on this program, you'd think that there wasn't much space, much oxygen left in the business to grow anymore. What's the pushback against that?
Well, today in the U.S., indexing represents, 15% of the overall market. So it's on the equity side and about 5% on the fixed income side. So there's still an awful lot of room to grow. I think part of the debate here, though, is, in a sense, it's focused on active passive. I think the better debate is on high cost versus low cost. And what I do think is you're going to continue to see, to your first question, is a secular change where investors and professionals who are advising those investors are very focused on cost. And, there's a place for active. We manage $1 trillion of active equities and fixed income, but they're very low cost. And, we think that's actually an important part of the active equation as well.
So Bill, if it's 15% now, how far will it grow? Take that 10-year time horizon that you say we're going to have lower returns on stocks and bonds. What's the limit, do you think?
Well, I don't know if there's a limit, but you could certainly see it double over the next decade. And again, especially as you go broader and more global. When you go outside the U.S., indexing is a pretty foreign concept in most markets.
So that money has to come from somewhere. If it's lower cost, that money has to come from somewhere. To what extent does that come out of people? What does that do to the employment situation in terms of active management?
Well, I think active managers are going to have to redefine their value proposition. And, what we see already is the best active managers, one, they're incredibly talented, but two, they have a real focus on their cost structure and making sure that they can deliver at a, I'll call it a lower price point. And this happens in every industry. If you looked at active management historically, just look at the publicly traded firms, they have operated with very high operating margins. And, typically that gets competed away in other sectors, and we're seeing that happen in our sector now.
All right, that was Bill McNabb of Vanguard. We have some breaking news here. A headline crossing that Amgen has won a ban on Sanofi's sales of the Prolin cholesterol drug. And this apparently is good news for Amgen, which is shooting up in after-hours trading, gaining by almost 5%. Once again, the headline here, Amgen winning a ban on Sanofi's sales of the cholesterol drug Prolin. We'll keep you posted on any further developments. What'd you miss? Bill McNabb is doing something right, as we were just listening from him. Vanguard took in a record $305 billion in 2016. That is the most ever received by an asset manager in a year. The cash came mostly through index funds and ETFs, but as McNabb was saying, also from active funds. So this makes Vanguard one of the few companies to buck the trend of outflows from active vehicles. Joining us now from our Princeton bureau is Eric Balchunas, our senior ETF analyst for Bloomberg Intelligence, our authority on all things ETF. Eric, we talk about this record $305 billion for 2016. Give us some context here. How does this compare to the old record to the rest of the industry?
Right. So I've been covering this stuff for almost 15 years. I've never seen anything quite like it. 305 billion breaks they set the record last year of 250 billion. But $300 billion would be good for the entire industry, let alone one company. They kind of remind me of Apple circa like 2007, where they're just firing on all cylinders, taking in money from in all areas. And investors have learned to trust Vanguard. I think that's a key word that McNabb, I think, alluded to but didn't say, which is over the years, I think when you saw the funds grow in their competitors, only Vanguard lowered their fees and passed on those economies of scale. So what you have is you have investors who trust them with everything, and they also feel like the low cost is beneficial. And then passive is part of it, but passive ends up being the whole story. But I think it's much deeper than just this move to passive.
So, Eric, while there is obviously enormous inflows into ETFs, there's also a growing ETF graveyard. ETFs that really never attracted much attention, didn't get the flows, and they had to pull the plug. So how concentrated and how winner-take-all is the ETF game?
Oh, I call it a jungle, right? I just had some research out today. If you look, I mean, there's only $6 billion in total revenue every year in ETFs. BlackRock takes 2.4. And they're the only one over $1 billion. So it is really slim pickings out there. The thing is with ETFs, all the money is after tax, self-directed, and picky. None of this is 401k money like fish jumping in the boat. So investors tend to be almost like early adopters. They're seeking out the cheapest of the cheap, the best vehicles. And so it is very competitive. And I just did something today that looked at Fidelity, Goldman, JP Morgan, there's like 7 or 8 companies. You combine their total assets, they only account for 0.05% of the ETF revenue. So it doesn't even matter how big you are. It takes a long time. You got to build liquidity. It's very difficult.
So there's a lot of room to grow, in other words. We actually spoke with Reginald Brown, who's considered the godfather of ETFs. He's at Cantor Fitzgerald. Take a listen to what he said.
ETFs are grabbing market share from hedge funds, and you're seeing the hedge fund pricing structure being repriced. And ETFs, as multi-factor ETFs become more refined, you'll see a lot of market share being shifted from hedge funds into ETFs.
So that idea that hedge funds are going to give up ground to ETFs, that's been talked about for a while here. It's not the first time we've heard it. In this new market environment where you don't have central bank intervention driving market forces and there's a lot more unpredictability, are ETFs better poised to take advantage of that, or are active investors like hedge funds still in a better position?
I think if active has a shot in the old school sense, hedge funds are the place because they can do some really interesting things. Whether people are going to pay 1.8 or 1.6 for that is another question. I have yet to see data that shows that people switch out of hedge funds to ETFs. Reggie has maybe a better front row view of that. But hedge funds lost about $100 billion this year. So that's not really necessarily money that went into ETFs. However, JP Morgan, Goldman Sachs, they're launching hedge fund replicating ETFs. So they're almost launching these hedge fund clones that could end up taking those assets, but that's yet to be seen.
All right, very quickly, Eric, you mentioned that investors trust Vanguard. What kind of company or who might be best equipped to rival Vanguard then?
BlackRock. I mean, at the end of the day, it's going to be BlackRock and Vanguard, King Kong Godzilla. BlackRock basically took in a little more flows than Vanguard in the ETF space. So Vanguard has a lot of liquid products. Those two companies are going to go at it for years to come.
All right, good stuff. Eric Balchunas, senior ETF analyst for Bloomberg, joining us from Princeton.
Up next on What You Missed, we head back to Las Vegas with another interview from CES. FTC Chairwoman Edith Ramirez joins us. This is Bloomberg.
Joining us now from the Consumer Electronics Show in Las Vegas is Edith Ramirez. She is chairwoman of the Federal Trade Commission. Edith, great to see you. Thank you so much for joining us. And one of the reasons you're at the CES is to launch a new initiative to try to encourage people to come up with solutions against hacking into the Internet of Things. Can you tell us a little bit more about this initiative?
Absolutely, and I'm just delighted to be here with you. So one thing, at the FTC, what we do is that we protect consumers and we promote competition. One aspect of that work is to talk about the impact that technology has on consumers' lives, and the Internet of Things is certainly one important aspect of that. And we've been wanting to draw attention to security issues that arise in connection with the Internet of Things. So a lot of us have these IoT devices. They're connected devices that help make our homes smart homes. So it could be a smart thermometer, it could be a wearable, like a fitness device that we put on our wrists. And so they bring a lot of benefits to consumers, but they also raise certain security risks. In particular, a lot of these devices are small and they have limited computing power, and that makes them potentially vulnerable to criminal hackers who might be able to access them remotely. And if they are able to do that, they might be able to then access your entire home network. So as a mechanism to try to address that issue, yesterday we announced an initiative. We call it an IoT challenge, and it's a contest. We're going to give a cash prize of about $25,000 to a person who develops a tool that will help consumers improve the security of their IoT devices in their homes. And so what we're trying to do is to call attention to the issue of security and also encourage the creation of technological solutions to these issues. And in particular, I'll highlight two problems with, or two issues and concerns with IoT devices. One is that manufacturers set default passwords that consumers oftentimes forget to reset.
Right.
There's also the issue of outdated software in our IoT devices. There might be a security vulnerability that's discovered, and then consumers forget that they need to update or patch the devices to address those vulnerabilities. So that's generally what we're doing.
Can you tell us a little bit about what kind of conversations you've had with the Trump transition team? Are you confident that some of these initiatives that you've had under the FTC or during your period at the FTC will continue?
So we've just started our conversation with the Trump transition team. What's called a landing team arrived at the agency earlier this week, so I had an opportunity to meet with that team. And, I talked a lot about the various initiatives that we have at the agency. We're mainly a law enforcement agency, but we also have important policy initiatives to address the challenges that we face, among them these IoT issues that I've been talking about. And look, the core of what we do is to protect consumers and to promote competition. I fully expect that work is going to continue under the new administration.
Very quickly, Edith, do you see the enforcement priorities consistent across administrations, or do you see it as likely to change?
At the FTC, you've really seen a lot of consistency over time, regardless of the particular administration. Again, what we're doing is we're protecting consumers and promoting competition. So we enforce the antitrust laws. And I expect, the vast majority of things that we do are bipartisan, are commissioned unanimously, most often votes unanimously in everything that we do, in most everything that we do. So I expect that tradition to continue.
And just 10 seconds here. Do you have any insight on who Trump might pick as your replacement?
I don't. I think I'm sure that the president-elect and the transition team are, giving thought to who will be selected. We have two vacancies right now at the commission, and those will be filled. And then also the president-elect, the new president, will have a chance to determine who the head of the agency is.
All right. We thank you so much for your time. Edith Ramirez, she is chairwoman of the FTC, joining us from Vegas. That does it for What You Miss. In terms of what's coming up tomorrow.
Jobs report. Jobs Friday, the best day of the month. Can't wait for it.
Have a great evening, everyone.
This is Bloomberg.